Good morning, everybody, and welcome to the Mpact 2024 annual results presentation. This morning, I'm joined by our CFO, Hannes Snyman, who will also present the results with me. And our chairman, Tony Phillips, is also in attendance he's here every year, so welcome, Tony. And all the other guests that are here in person, welcome to all. And those online also welcome to this presentation. There will be an opportunity at the end of the presentation for questions and answers. And I think the protocol is very well understood, so I won't go through that because actually, to be honest, I don't know exactly what you have to do, but I'm sure you'll work it out. And Marlies will then ask us the questions at the end that you post, or you can ask in person if you want, and then we would do our best to answer them. The presentation, and including Q&A, won't take longer than an hour. So 2024 was, without any doubt, one of the more difficult years that we've experienced as a group for a number of reasons. One, we had a very challenging and uncertain operating environment, with trading hampered, especially for the first 3 quarters, by a weak economy. We saw lower consumer and business confidence during the first half of the year, especially up until the election. One is quick to forget that we had load shedding up to stage 6 until March last year on a routine basis, which had a big impact not only on confidence but on capabilities of producers and consumers alike. And once the load shedding ended at the end of March and there was opportunity for a little more optimism, everybody was waiting for the election, which was in May, end of May, to the extent that we even had customers, in early May, end of April, saying that they didn't want their orders made until after the election, and if it was made, they didn't want any deliveries, especially in KZN and some parts of Gauteng, because they didn't want to sit with the stock, in anticipation of anything going wrong. So there was a lot of nervousness leading up to the election, and I must say, certainly we were, and I'm sure most people were quite pleased with the outcome after the election. And a wave of optimism swept over us all, justifiably. But the first signs of any recovery didn't actually come immediately after the election. They actually came towards the end of Q3, and that was only after interest rates started coming down, albeit modestly, and inflation started to decline. The prices still remained high. And we saw some recovery in the last quarter, end of Q3, Q4. But it wasn't really sustained, up until now. I'd say that we saw, contrary to the year before, we did see a peak, but the peak was more around October, November than necessarily in December. But at least there was a peak. You might recall the year before there was no real peak in the economy going into December. But the early stages of this year would say that things are still quite subdued. With that, we also, in our own team, we had a number of our colleagues had some personal challenges which put us under quite a bit of pressure, but fortunately those resolved. And under the circumstances, most of our operations actually delivered commendable performances despite the tremendous headwinds, demonstrating both financial and operational resilience. We increased sales across many of our businesses in a very difficult market. And I'll explain just now, while some of those increases, for example, in bins and crates, we're up 17%, were very good. They were below what we had actually targeted, and there was an impact because of that. And we had good cash generation from operations of 1.9 billion rand, which is 100 million rand short of our record the year before of 2 billion. So that was encouraging. And our net debt reduced to 2.4 billion rand from 2.7 billion rand a year earlier, with our gearing down to 28.8%, which is the lowest it's been in 4 years, and close to the lower levels it's been. And that's after investing 1 billion rand in capital projects and paying out 155 million rand in dividends last year. And all of that fed up to our NAV per share going up by 6% to 35.76 in the year. But against that, we also had a decline in our profitability, which was affected by lower selling prices and a number of once-off costs, which I'll delve into as I go through the presentation. Through the year, we made good progress on our strategic projects, and those of you who follow our company would know that that has two elements. One is portfolio optimization, sort of, excuse me. Portfolio optimization is really about reducing our exposure to businesses and sectors where the returns are not meeting our hurdles, or where the products are not sustainable to the extent that we want them to be, and we don't see a pathway to getting that sustainability. And the other one is growth projects in the areas that we are. So on the portfolio optimization side, you would have seen that we've sold the Mpact business at the end of last year that makes styrene trays and PVC foam. For that, we received our 255 million rand in sale proceeds in the last quarter. We also managed to recoup 50 million of the working capital that was outstanding, with another 100 million to come, which I'll cover a bit later. That was in November. In April, we acquired a minority interest in a company called Africa Tanks, the largest and only producer of blow molded water tanks in South Africa for household and industrial use, up to 5,000 liters. That business is doing very well and has already contributed to our results just in the 9 months that they were included in the company as an associate. And as I'll go through in more detail just now, our plastics FMCG Wadeville plant, which has had many troubles in the last year, has been successful in realigning its product portfolio, notwithstanding those challenges, away from preforms for large beverage manufacturers to a more diverse product range. And I'll talk about that in a bit later. On the growth project side, our upgraded Felixton paper mill, which was completed at the end of 2023, has exceeded all expectations, both in terms of its runnability, its operability. So the quality of the product it makes, the rate at which it produces, and also the cost of production is well below what we had anticipated, and the throughput is well above. So that was a very successful project, and even in the toughest year, Felixton was able to maintain its profit at a similar level to what it was in the prior years, which just demonstrates where that machine is positioned. Our corrugated factory upgrades in Nelspruit and Port Elizabeth, otherwise referred to as Mbombela and Gqeberha, they contributed positively. You'll recall that those were put in place to support the fruit sectors in those areas, and I have some slides a bit later just to cover some of that. And then our plastic containers Castleview project, albeit was completed somewhat later than what we had originally anticipated. The automated warehouse has now been commissioned, and it's in its final stages of testing. It can carry 9,600 pallets, and the final stage is filling it with pallets to see that they all are maneuvered automatically as they are intended to be. And I have a video just now that I'll show you about that. And then the final project that I'll mention is the Mkhondo Mill upgrade project, and we have a slide on that. Construction is in full swing, and I must say our team is doing well to navigate several challenges in that project, but it's going along. Other areas of the business that have made progress last year, we had a 79% increase in our own solar generated power last year compared to the year before, saving us over 40 million rand in electricity costs when compared to buying electricity from municipalities or Eskom. So that was very encouraging. We're looking now at the sort of carbon footprint and things that go with that. We have more solar installations underway as we speak, and still a pipeline to come. So most of it behind our own meter, but there are some that might go on the other side of the meter where we'll be able to sell some, depending on the economics. Something we haven't spoken about before is our digital twin project. So we've developed our first digital twin. Some of you may be familiar with digital twins. It's of a piece of production equipment in our Felixton paper mill. And it was really call it a development project, one to expose our colleagues to building these digital twins, and also to derive the benefits that they would bring if we're successful to really optimizing our plant beyond what you would do just with your normal facilities. And we had a very successful CFO transition with Hannes here today and joining us from the 1st of June, and he's made a really meaningful impact and positive contribution since joining last year. And we also had a number of awards to demonstrate that our efforts in innovation are working. Our e-learning academy has grown after a recent upgrade. We've had over 6,000 course completions in that program, which is very encouraging, offering our employees an opportunity really to develop themselves to better their prospects. And we managed to retain our level 1 BE status for Mpact operations. And then finally, you would have read maybe on the SENS announcement in around September, October, that the 2016 Competition Commission investigation was finally concluded and resolved. And that was also very positive to have that wrapped up. If we move on now to just some video slides and short clips on the various projects. The first one being the Mkondo mill upgrade. The first parts of the slide are as they were in the past, and then we put also an update on the cash flow, you'll see there, and then an update as at the end of February. So the project is still due to be commissioned by the end of June this year. We have moved the shut. The shut was meant to have been done in March, actually. We moved it to June, 3 months. I must say that project team, as you know, with all project teams, have had all things to deal with. There was a tornado, you might have read in the press, a tornado in Piet Retief in December. We just got the fringe of it at our factory, so there was no damage, but a number of our staff had their houses flooded with rivers going through. One guy had a big tree fall on his house, one of our project team. Despite that, I must say the guys kept their shoulder to the wheel. Up until the middle of December, for those who didn't know, I mean, there was in that area in Mpumalanga, around that southern Mpumalanga, there was a big fear about drought. I mean, many of the tree producers, I was chatting to some of the tree growers there. They'd taken out 800, they'd planted 800 trees 1 month. The next month, they're all dead because they didn't have water. And until middle of December, we supply our own water in the Piet Retief mill from a river 10 kilometers away. And we were pumping water down the river, to make sure the mill had water until the rains came. And we were concerned that we might be into a drought season. And then from the 15th of December until now, it hasn't stopped raining. And so now we've got lots of water, but when you're doing a construction project, that's not always a good thing. But so there's been a couple of delays due to the rain. But we are still planning to finish the commissioning of the main plant and equipment by the middle of the year. There will obviously be some troubleshooting and startup thereafter. And the project budget is still within the previously announced 1.3 billion rand. And the project returns are still attractive. We said that the project returns were anticipated to be above 20%. We constantly, in terms of IRR, we are constantly updating that model, and those returns are still there. The main additional product that will be sold from Mkondo will be sodium lignosulfonate powder. And the pricing for that has remained quite stable in US dollars, and the rand has weakened, which is also contributing to that. And then, of course, the project cash flows are delayed as we have taken the 3 months longer to get to the main shut. Here's a video. And here, this picture here is of the sodium lignosulfonate spray dryer. So I don't know if I can show. I'll show the people in the room here, but you can just pass us the pointer there. But anyway, the big structure on the right, that big thing with all the scaffolding around it, that is the actual spray dryer. So you spray black liquor into that with hot air that is generated in this hot air generator on the right, just next to the crane. That hot air blows through there, is passed through there, and the liquid is evaporated from the powder, and the powder comes out in that form, and it goes into a bagging plant, and you sell the powder. And so what sodium lignosulfonate, for those who are not familiar, it's basically containing the organic and inorganic compounds that the organic compounds you've extracted from the wood and the chemicals you use to extract it, and then you sell that as a binder to the cement industry. And in the foreground on the right picture, you'll see that tower there, that's an evaporator. So that's a big plant. I'm sure many of you have built your own houses, and those who are in industry, you know that what you see on paper looks like just, I don't know, A4 is small, and when you build it, it's pretty big. So this is a big plant. This is only a part of the project. Of course, another main part of the project is on the pulp mill, which we don't have a picture of here. On the left is the same plant, just from a different angle. So you can see sort of extent of things there. It's a big project. Then in our paper converting business, you might recall that we had our upgrade at in our Port Elizabeth corrugated facility. That's gone well, and it has been completed now, with our new customer service center recently commissioned towards the end of last year, and also the new materials handling lines inside the factory. And here's a short video just to show you some of the aspects of that plant.
My name is Malusi Malinga. I'm the operations manager at Mpact Corrugated in Gqeberha. For many years, Mpact has been a trusted partner to South Africa's citrus growers, supplying the essential cartons that carry their produce to markets around the world. As the citrus industry continues to grow, so do we. To support this expansion, Mpact has made significant investments, ensuring we remain a long-term partner. These upgrades include a state-of-the-art corrugator with a first-in-Africa work-in-progress solution, all housed in our 32,000 square meter factory.
Beyond our corrugated packaging facilities, Mpact invests in upgrades at our Mkhondo paper mill, where the semi-chem fluting paper used in citrus boxes is produced. This strengthens our supply chain, securing the availability of high-quality paper now and into the future. We recognize the challenges of shipping citrus across global markets. The new corner lock concept from Mpact is globally novel, and we've embarked on a different approach to fundamentally understand how the individual cartons interact as a palletized unit. This provides the benefit of vertical compression strength and greatly improved pallet stability.
At Mpact, we are more than a supplier, we are a committed partner. We are committed to delivering solutions that support the citrus industry's success, sustainability, and reliability.
So that gives you some sense of what's going on in Mkhondo and also in PE. And that box lock that Wouter spoke about at the end is replacing a very, a slip sheet that goes between the fruit boxes on a pallet, and has brought such stability that when the fruit gets to the other side, the quality is so much better. So a very simple solution to problem, and very encouraging. The other project which I'd report on is the plastic containers Castleview project. We've completed now the automated warehouse. It's in the final sort of testing phase now. Also a very exciting project. You might recall that we accelerated the phases of this project a year or two ago by the incorporation of a printing facility for crates, which you'll see in a video that follows. But we also bought a number of the injection molding machines from one of the other producers in South Africa that closed down. Mpact sold some of their machines to us in 2023. We've commissioned most of those, and they're in operation there. So the plant was due to get to 15 machines in 2027, originally, but we got to 14 by the end of the year before. And one of the reasons why we missed our target actually in the bins and crates business profit-wise is because we geared up to run all of them for the whole year last year. Resource-wise, manning and other. But we didn't actually get all the business through last year. So we ended up with a fixed costs and not all the revenue. But that aside, our targets were very ambitious. The project of Castleview is still delivering the returns that we would have expected. It's slightly below at the moment for the stage of the project. And the prospects are still extremely good. So here's a short video just to show you what that warehouse looks like. So all the crates you saw outside in the yard at the end of the video, near the end of the video, those would in future be inside. We spent a good 10 or 15 years not getting into the bottling industry in that business because it is generally the lower end of the market. And we've always maintained, and we'll still do that, make sure that it doesn't become a big part of that business, because you don't want to be, it would be like a bit like Wadeville, where we became quite dependent on one bottler for preforms. And we don't want to do that here. So while it looks like it's large there, in the context of the plastic containers business, actually the crates are not necessarily, those beer beverage crates are not necessarily the biggest proportion. So that's progressed well. Another area of our business which we've really put a big effort into in the past years has been innovation. And the best test of your innovation success is your industry peers voting for you to win awards and be recognized. And we were recognized with 10 awards for 8 different products last year, which is very encouraging, and just demonstrates that what we're doing is making a difference. I should just add that the stuff, for example, like on the digital side, like the digital twin, that is a level of innovation that probably wouldn't be in the market, but there's a lot of that we are working on to try and improve our prospects going forward in terms of our competitiveness, which is also very exciting. Moving on now to the financial review, starting with the group. The group revenue increased by 3.6% in 2024 to 13.3 billion rand. And bear in mind, all of these numbers are excluding VersaPack, which was sold in November, so the comparatives and everything. And that revenue increase was on the back of a 1.6% increase in volumes and average selling prices going up by about 2%. But it is worth just noting that the average selling prices across the business probably didn't go up in unit terms. That was on a mixed basis, really. In plastics, the prices were up about 2%, but the paper prices were down or in line on average. So that's to be borne in mind. What's interesting to note here is the difference between the first half and the second half when it comes to volume. So in the first half, our volumes were down 2% on the prior year, first half, whereas in the second half, the volumes were up 5% compared to the prior year. And in paper, the difference was a lot greater, and I'll cover that a bit later. Whereas the plastics business was more or less 14% both halves, 13 to 14% both halves up on the prior year, excluding Wadeville. When one looks at the gross profit and the gross profit margins in the paper business and the plastics business, it's quite important to bear in mind there's a couple of anomalies this year, so they can be a bit difficult to interpret. So plastics was a big mix change, so when one looks at that, Hannes will talk about it, bear that in mind. On the paper side, the gross margin percentage did decline by 1 percentage point, and that was largely attributable to the prices coming down to some extent and their variable costs going up. But in plastics was a big change of 7 percentage points, and that's because of the difference between hard tolling and soft tolling. Where hard tolling, the raw material is paid by the customer, which was what we were doing in prior years, and soft tolling is where we buy the raw material. So if you change that mix, your gross margin will decrease if you increase the proportion of soft tolling. I don't spend too much time on that, but it's just worth bearing in mind. Underlying operating profit for the group of 923 million rand reflects the under recovery of higher fixed costs, and that was in both the paper and plastics business, but for different reasons. In the paper business, the under recovery was due to prices coming down in effect, on the paper manufacturing side, whereas variable costs went up, and there were also fixed cost increases, albeit lower than inflation. They were there. Whereas in the plastics business, we actually incurred higher fixed costs because we geared up for more sales than we achieved in the year, in summary. But I will cover that in a bit more detail a bit later. And then, of course, we had these non-recurring expenses, which are important just to remember when you are looking at comparatives. So just to give you at a high level, the total non-recurring expenses in 2024 came to 130 million rand, big number. Whereas in 2023, we had a 26 million rand income on non-recurring. And so the difference, if you look at the comparatives, is 156 million rand. If you adjust for that, the operating profit still declined by about 11%. and most of that is due to the lower prices in paper, manufacturing, and also the higher fixed costs in plastics, based on gearing up for volume we didn't achieve. But Hannes will unpack the costs in more detail a bit later. All of that translated to HEPS going down by nearly 30% to 324 cents, and ROCE of 11.7%, where we have also the large outlays for capital projects that are still underway, and lower profitability in the business. As I mentioned earlier, the gearing is down to 29% with net debt of 2.4 billion rand. The total dividend for the year, with a 75% dividend for the second half, 75 cents, comes to 105 cents. Moving on now to the operating review, starting with the paper business. In the paper business, revenue was up 2.7% to 11 billion rand. That's largely due to an increase in sales of 3%. The paper manufacturing business was really did well to adapt its approach to the market during the second half to the prevailing circumstances then. I did explain in August, but I'll just repeat it today, that up until the middle of last year, for the 3 or 4 years prior to that, we did something we hadn't done in years before that, the decade before that, and that is take a lot of commercial downtime. And our approach to that was simple, actually. It was sort of based on the theory of constraints. If you don't have orders, you shouldn't produce. That's as simple as that. And in a very soft market, there is this temptation to carry on running, you know, into stock, and hoping that you'll eventually sell. But what that does in a very weak market is you end up with a stock, and you end up anyway taking the downtime because you run out of space, and your sales guys end up discounting the stock. So you have a double whammy. So, you know, from just before COVID until the middle of last year, we took the view that the best thing to do is, when we don't have orders in this environment, even though we've got a strong position in manufacturing competitiveness, we took downtime, and that we classified as commercial downtime, you may recall. But from the middle of last year, we saw the market turning a little in terms of export orders were there, because in the past the export price wasn't bad, but you never got any orders because the market was in some sort of turmoil. So we saw for the first time we could get orders, and they were actually at more than just a contribution. You know, they were making a decent contribution, and we could get the sales. And so from the middle of last year, we started accepting export orders, and we increased our exports quite dramatically in the paper manufacturing business, and successfully, because we think it saved us a good 50 or 60 million rand in terms of additional contribution doing that, compared to we've carried on taking commercial downtime. And that was very pleasing, because it meant that we saw a 7.5% increase in sales without our stocks going up, I must add, because we didn't increase our stocks. We made sure that we had sales for the production we had, and much better paper machine utilization, because in the second half we didn't have any commercial downtime in our containerboard paper mills. And so the commercial downtime reduced to 6.6% of capacity for the year. And most of that was in the first half, compared to 13% the year before. But as I mentioned earlier, the benefits of the increased utilization were offset by the lower prices on average, because the prices came down about 7.4% on average. And that's mainly because of the mix of both geographical mix, exports versus domestic, and also some of the product mix in there as well. And the product mix difference is because as you grow containerboards, they're priced at a lower level than cartonboard. And so if your containerboard grows quicker than cartonboard, then your average price will go down. So that also is in that mix of 7.4. Talking of downtime, while our containerboard mills have been pretty stable, our Springs mill has experienced significant production downtime due to ongoing municipal water and electricity supply issues. You know, we're meant to have a load curtailment arrangement with our local municipality in Ekurhuleni, and when the load shedding hit us just 2 weeks ago, the stage 6, suddenly our machine was down for half a day, 3/4 of the day, and a paper machine takes for us to start up, which meant that we were suddenly struck, you know, unexpectedly. And that was because the municipality wasn't managing the load curtailment well, so Eskom just took over the load shedding, and they just shed the whole region. So that's been a challenge. We have put in the 5.4 megawatts of solar there, but that doesn't make us self-sufficient. And we are looking at other means of supplying our own water or storing water for a longer period. And we have engineered some solutions there, but they'll take some time to implement, and they'll be quite costly as well. So in total, the group's downtime attributable to external utilities, mainly water and electricity, is 2.6% of capacity, and that's mainly at the Springs Mill. It's worth just reminding you that in terms of Felixton and Piet Retief or Mkhondo, we supply our own water from rivers, where we have our own pump stations and our own weirs, and we've never really had any issues with that over decades. And our electricity is directly from Eskom, and they've been very diligent in making sure that the load curtailment agreements are held to. And so we haven't had any notable downtime due to Eskom either, other than just power dips here and there, but nothing like at Springs. So the volumes in the paper manufacturing business, I mentioned paper overall was the paper business overall, the volumes were half and half. In the paper business, we were 8.3% up in the second half and 2.5% down in the first half for the overall paper business. But in paper manufacturing, that is containerboard and cartonboard, the first half we were down 1%, and the second half we were up 15%, which just shows the impact of those exports. In paper converting, our volumes were more or less flat year on year, and the half and half was also similar. I mean, we were down 1% in the first half, up nearly 2% in the second half. So talking of paper converting, our volumes, as I said, were similar. We had good growth in the fruit sector, and we have been gearing up for growth coming there, which was encouraging. Average selling prices were more or less flat, slightly actually. The growers in the Mpumalanga region, Limpopo region, and Eastern Cape region have shown good growth, and we've been able to support that growth through our upgrades in those areas, which has been very encouraging, and those businesses are contributing positively. Sales to the industrial market remain subdued in line with a broader economy, I'd say, but also we had some issues continuing at our corrugated factories in Gauteng for a better part of last year, and that also hampered our ability to service that market. We are working hard to resolve those and turn the prospects of that business around. The issues in Mozambique, on the face of it, were small for South African businesses generally in our sector, except for some of the exporters who are using that port to export, but they would divert down to Durban. But we have a factory in Mozambique. It's a small factory, but we also supply from our Nelspruit factory into Mozambique. And the political unrest and other factors there cost us probably 40 million rand. So 20 was direct cost, but we also took a provision of 20 million rand in the period as well. In the paper business, the underlying operating profit was just over 900 million rand. And here I should just mention once again those differences year on year of the non-recurring costs. So in the paper business this year, 2024, we had costs of 65 million, whereas last year, because of an insurance income for the Springs Mill downtime in years prior, we had a 76 million rand income. So if you net those two, then your comparable difference is 141 million. If you adjust for that in the EBIT number, EBIT was down about 11%, and most of that is attributable to the pricing, about 100 million rand. Fixed costs, other than those items, were well managed at 4.1% up on the prior year, which is below inflation, and in the environment where you still have quite high costs for imported spares and things like that, above inflationary costs for insurance. Anybody who's in business here, manufacturing, I'm sure you know what your insurance line looks like now, because it's gone up for the last 3 or 4 years by 25 or 30% a year. Although ours hasn't gone up as much, but it has escalated. And then IT costs have also escalated quite a bit in the last years, and Dennis will talk more about that. Moving on now to the plastics business. In the plastics business, our revenue increased by 8% to 2.3 billion rand. But to explain this business this year, I think I must just start by making sure everybody's on the same page as to what we're referring to when we talk about each of these businesses. And then I'll explain excluding Wadeville because there was a big variance there. And then I'll deal with Wadeville separately. So just to recap, the plastics business as it is currently, because we sold Versapack, has two divisions now. The first one is called Bins and Crates. And those of you who have attended our presentations in the past will remember the crate that I gave out last year. It's worth coming, although this year there are no crates, sorry. Those collapsible crates and jumbo bins and beverage crates and, retail crates, the ones you see in the shop at Woolworths, those black crates on the dolly. We make the crates and we make the dolly. So that's bins and crates. Then we've got what we refer to as FMCG, and FMCG has three plants, and the first one is in Wadeville that we used to call preforms and closures. So now it's just referred to as FMCG Wadeville, so we don't get confused with that. And then we've got a plant in Pinetown and a plant in Atlantis, and those three together make up what we'll in future refer to as FMCG. For today's presentation, I'm going to refer to Wadeville on its own and the other two plants separately, because Wadeville needs a separate explanation because it had lots of troubles. So the volumes in both bins and crates and the balance of FMCG actually increased quite nicely last year. So bins and crates were up 17% in volume. Their revenue was up 19%. With good growth in the agricultural sector, there we've seen good growth in blueberries, avos, and jumbo bins in the past year. We also had quite good growth in the retail sector. Those are those crates I was talking about just now on the dollies and what have you. But we did battle in the environmental sector, for example, wheelie bins, the wheelie bins that you have outside your house. We didn't necessarily battle in the context of year-on-year growth, but in terms of our targets, we didn't hit them. And one of the reasons was that we anticipated there would be, normally in an election year, wheelie bin sales fly because each party wants to, where they are in power, they want to demonstrate service delivery, and nothing does that better than a wheelie bin. So we geared up for that, but those sales didn't materialize, maybe because the municipalities actually didn't have cash, come closer to the election to spend on those. So that sector battle, but generally 17% up in bins and crates. And in FMCG, excluding Wadeville, our volumes were up 4.3%. We anticipated more because we had some new contracts with customers that we had geared up for, but they didn't actually, they didn't have takeoff in the year for a variety of reasons in their own businesses. So the 4.3, I think, was a good achievement on a like-for-like basis because it demonstrates that our top-tier customers there have really maintained their market position and in many cases grown their position, which was very encouraging. But in both bins and crates and FMCG, that growth didn't necessarily translate into higher profit, or the high profit you would expect. So in our report, we say that the bins and crates business nearly doubled its operating profit, which is true. But if you take out the year before where we had quite a big loss due to the polymer supplier, and you normalize it for that, the profits sort of were on a similar level. So while they high, bins and crates makes over 250 million EBITDA. It's very good, and it's in line with the projections for the project of Castleview. It was well below what we had anticipated by our own ambitious targets. And with that, we increased the costs to supply these customers that didn't eventually take off, and that absorbed the gross margin, gross profit. And the same sort of thing happened in FMCG. So in retrospect, we had to wrestle through the year with, do you just cut the resources and run the risk of your customer eventually saying, okay, I'm ready, I want the product now, because the promises were there, but the orders didn't come? Or do you hold and expect that they would come as they've said? And we did the latter, and in retrospect, we should have moved quicker in downsizing those particular production lines. And that cost us quite a bit in the year. So that deals with the FMCG excluding Wadeville and bins and crates. Hannes, did I miss anything on that so far? Because we thought this is the easiest way to make sure that everybody gets a understanding. Moving now to Wadeville. Now, Wadeville, you might recall, that's where we make the preforms and closures and bottles and jars. We had a contract with a big beverage producer, which ended in June last year, the bulk contract. So we anticipated the volumes coming down, and they did come down. And we've actually done well to shore up some of that capacity, or do something with the capacity there to sell into different sectors, and those projects are coming on nicely. So the volumes were down 35%. The revenue was only down 13%, and that's because of the mix between hard toll and soft toll. For those who are interested, I'll go through it in more detail, after the presentation. But in essence, that's what happened. But the big disappointment in Wadeville was really the 90 million rand in costs that came, related to the closure of this business, or the termination of these contracts and all that went with it. The easiest way to sort of look at it is just say, with that 90 million in, Wadeville made a 71 million rand EBITDA loss, which would mean if you took those out, you'd make a 20 million rand EBITDA profit, which is still below what we had anticipated. So the sales didn't meet the new projection, but they are coming through now. And with the portfolio optimization that we are doing there, we still believe that there are good prospects for that business. And we had to clean up. I must say, Hannes started in June, and within 3 months, he had really managed to help the team there sort out this story with the various matters that we had to deal with there. So that is what happened there, and that meant that the business took a big knock in the year. And we've obviously done a lot to make sure that is dealt with and will not happen again. And some of those costs, actually the biggest proportion was in variable costs. The small proportion, about 70 odd million, was in variable costs. The balance was in fixed costs. Moving on now to Versapack, which has been shown as a discontinued operation. I'm not going to go through all the details here, other than to say that we did receive our 255 million rand for the sale proceeds. We also collected 50 million rand net working capital by the end of last year. And in this first half of this year, we'd expect to collect another 100 million rand of working capital. So if you go and work it out on a historic EBITDA basis, it's been quite a good cash return for that business that we were battling, to find a long-term future for, given its focus on styrene and vinyl film. So that was, I think, a welcome outcome for that sale process. I'm going to now hand over to Hannes, who will take you through some of the details of the finances, and then I'll come back and give you some feedback on the outlook. Thank you, Hannes.
Thanks, Bruce. Good morning, everyone. So on variable costs, our variable cost increased by about 6.2% year on year. If we look at it on a per ton sold basis, it was about 4.5% per ton. Our revenue increased by 3.6%, which means that our gross margin reduced. So last year, our gross margin was about 39.9%, and it's come down to 38.4% in 2024. On paper raw materials, costs were up by 2%, mostly due to higher sales, as well as an increase in recovered paper prices. So average recovered paper prices per ton increased by about 2% year on year if you look at 2023 versus 2024. The pricing in the second half of 2024 was about 11% higher when compared to the second half of 2023 and the first half of 2024. This may not seem obvious when you look at the OCC benchmark slide, which is on the page in front of you, but our local market often lags international markets. And for the first 2 months of 2025, OCC prices are about 6% higher than the average purchase prices for the 2024 financial period. Plastics raw materials increased by about 15% year on year, and that's, as Bruce explained, largely due to a change in mix between the hard tolling and the soft tolling, where sales in FMCG Wadeville were lower and bins and crates were higher, where they purchased for most of their customers, they purchased their own material. Energy costs increased by about 7%. Business had to absorb about 13% of regulated price increases there. That was offset by lower coal prices, reduced spend on diesel for generators, as well as the benefits from our solar investments of more than 40 million. Variable selling and distribution costs are primarily higher due to the paper business. So as Bruce mentioned as well, our containerboard sales are up more than double year on year, and they attract a higher variable selling cost. Other costs increased by about 100 million year on year, And about half of that is an increase in our chemical costs. And that's due to higher pricing as well as a change in mix. And we also had some instability issues at Springs, which uses coating chemicals for their product. And that's largely due to utility interruptions in that business. There's also a big increase in our waste management costs that sits in that number. And that's actually as a result of the growth in our Mpact waste management business, which is up by more than 50% year on year. So fixed costs. So on the slide there, you'll see there's a graph with numbers. Those are the reported numbers. As you would have heard, there's a lot of one-offs coming in and out in the 2023 numbers as well as 2024. So I'm going to talk to kind of using the numbers on an adjusted or normalized basis. So if you look at total fixed costs, excluding depreciation and all these one-offs in the prior year and current year, it's up by about 5% year on year. Personnel costs on the same basis increased by about 3%. And that's if you exclude the retrenchment costs of about 22 million in FMCG Wadeville and corrugated Gauteng. Maintenance, that's up by 6.8%, and that's primarily driven by the increase in bins and crates, the footprint there. And as Bruce mentioned, the rest of the business, the maintenance was inflationary. Other net operating costs, even if you exclude all of the one-offs, that moved by about 9% year on year. And the big reason for the increase there is M&A activity, so the sale of Versapack as well as the acquisition of Africa Tanks. And then there was above inflationary increases for IT, insurance, and security costs. We do believe there's an opportunity here for cost savings going forward. The depreciation and amortization increased by 8% year on year, and that's 9.5% is due to depreciation due to major projects which were capitalized only at the end of 2023. You will note on this slide that there's a little note next to 2023, the numbers there. And we had to restate our tax numbers, our tax charge numbers for 2023. And that was large. The main reason for that was to actually disclose our Versapack discontinued operation on a after-tax basis. Historically, it was disclosed on a pre-tax basis. So your total tax charge for the group didn't change. It's just the allocation between discontinued and continued. And going forward, that will obviously be out of the system. The effective tax rate of 12.3% is also lower than the statutory tax rate due to the recognition of deferred tax assets in our bins and crates business of about 73 million. So you'll remember there was last year, there was about 64 million that was recognized. And as the end of December, there's still about 150 million left. On an after-tax basis, it's about 40 million. We also had a positive variance related to tax allowances claimed on submission of tax returns. Other items to note on this slide is that there's an increase in a non-controlling interest. So you'll see that's up by just over 40%. And that's because of the increase in profitability in bins and crates, where we own 66% of that business. Also under special items for last year, you'll see there's a 93 million outflow. And that was all the goodwill that was associated with FMCG Wadeville that was written off in the prior period. Our net debt reduced by about 300 million to 2.37 billion at the end of the year. And that's mainly due to a reduction in working capital as well as the sale proceeds that we received from Versapack. Our finance costs are still slightly up on the prior period. And that's because of the average net debt being higher still for 2024. And the benefit from the working capital as well as the sale proceeds only came in the fourth quarter of the year. So we didn't get that full benefit during the period. Just to note that there was also 47 million of interest that was capitalized to the Mkondo Mill project versus 14 million in the prior period. So let's see on the next slide on the cash flow that the interest will be higher than this number. In December 2024, we extended maturity dates for some of our debt facilities. So we had 1.1 billion rand of long-term revolving credit facilities due to mature in August 2025, which was extended to August 2027 with no impact on pricing. And we also extended a 300 million rand facility in bins and crates from December 2025 to December 2026. So at the end of the year, we had committed facilities of about 4.7 billion, and there was headroom of about 1.6 billion on gross drawn debt, excluding the cash. We have also started engaging our bank partners to look at refinancing. And the reason is really that if you can look at the headroom, there's quite a lot, and we're coming to the end of our capital cycle or CapEx cycle. So we'll look to downsize that and right-size it for the business. This will be evaluated closer to the time, though, as the first upcoming maturity date is only in August 2026. So this is just a snapshot of the movements from net debt year on year. So you can see that if you take the cash generated from operations and the working capital, that's the 1.9 billion. In terms of the main outflows, there's the 1 billion that was spent on capex, of which 424 million relates to the Macondo project. The net interest, the 343 million on this slide, that includes the capitalized interest for the Macondo project. And then you have the corporate activity inflows and outflows. So the 255 or 54 million from Versapack, offset by the 72 million rand investment in Africa Tanks. Our working capital improved significantly in 2024, largely due to a reduction in trade receivables in our paper business, as well as the sale of Versapack. As Bruce mentioned, we've recovered about 50 million of the outstanding working capital, and there's about another 100 million of debtors that be due to collect in the first half of 2025. Just to note that the working capital reduction in 2024 was a very strong result, and it will be quite difficult to repeat in the current environment, given increase in exports, the growth in the agri sector, and continued pressure from multinationals to extend payment terms, which will put upward pressure on this number. We also may have to carry more stock at certain operations to cater for utility disruptions to make sure we're able to service our customers. The ROCE number declined to 11.7%. This is largely due to relatively large capital outlays for strategic projects which are still in progress and lower profitability. It's worth noting that as at year end, we had about 1 billion rand of capital employed, which does not generate earnings yet. And about 770 million of that relates to the Macondo Mill project. So it's in your capital employed number, but it's not generating earnings. On the capex, so we spent about 1 billion rand of capex, of which the majority was in paper and the majority of that was in our Macondo project. So in plastics, we also spent some money on expansionary products. 60 million was spent in the Castleview factory for bins and crates, and 40 million was for FMCG. The total capex of 1 billion was lower than the 1.2 we highlighted or projected during our interim results. And that was largely due to curtailment of capex instituted during the year due to generally weak trading environment. At year end, we had outstanding capital commitments of 1.5 billion, and we expect to spend approximately 1.1 billion in the next year, of which about 450 million relates to the Macondo project. However, capex will be closely monitored and evaluated based on trading conditions at the time. And we do expect this number to come down in 2026. The board has declared a final dividend of 75 cents per share, which is in line with the final dividend declared in 2023. This reflects our view of the importance of shareholder returns and continued confidence in the future of our business. Thank you. I'm going to hand you over to Bruce now.
Thank you, Hannes. Moving on now to the outlook. Like many businesses, I do believe that we are very well positioned to capitalize on any recovery in South Africa that we are all hoping for. But if I take the most recent trading, the last couple of months, it's not that evident at this stage. Things are still relatively subdued. But I should just add that in our business, the first quarter is not a good measure because it's generally very weak. So, it's hard to say that that is a good barometer. But should there be any significant uptick, we are ready to take advantage of it. Our Mkhondo paper mill upgrade will be commissioned by the end of June, as I mentioned, and that's following 3 weeks of planned downtime in June. The financial benefits of the project, as we have said many times before, will not be realized immediately, but they are expected to increase over about a 3-year period, depending on the market growth rates. Just to emphasize that the semi-chemical fluting is going to be supplied into the growing fruit sector, so one needs to see that growth come through before you'll see full demand of that. We don't expect to take any commercial downtime at our containerboard mills this year, based on our current sales orders and commitments for the year, which should give us a benefit of operating leverage with more volume, but that would be offset by lower prices because pricing of containerboard and cartonboard is still under quite a bit of pressure at the moment. The outlook for the fresh fruit export sector is promising. I mean, producers are pretty optimistic at this stage. Had good rains, and I was chatting to some table grape producers over the weekend. Pretty optimistic, and also citrus is looking reasonably good. So with that, we should see a benefit in our bins and crates business and our corrugated business. And then, of course, we do expect to see an improvement in both our plastics FMCG business and our bins and crates business this year compared to the travails of last year, especially in Wadeville. So our strategy is pretty clear. I think we're confident that it is a good strategy, and we've shown, I think, in the last year, our ability to maneuver, although there were some things that we could have done better, without any doubt. And we are remaining very much committed to delivering that strategy in the years ahead, and remain optimistic about the future prospects of the business. So thank you. I'd happily now take any questions. So Marlies has got a mic there, and she's going to put them to us. Here, Mike Lawrenson.
Hi, Bruce. Can you hear me?
Yes.
Just on bins and crates, you mentioned in the in FY24, you had an issue that the offtake didn't meet expectations. Just given that, are you reviewing your fixed cost base and looking at reducing that fixed cost base?
Yeah, I think it was, in retrospect, we should have done it sooner last year, but we've sort of waited. We had hope, but we should have actually just made a change. So we have done that. We are changing the base to reflect the sales we have, not the sales we hope for.
And how significant is that fixed cost reduction in the base?
So the fixed costs in plastic containers alone in bins and crates went up 31% last year. So it's more than 20 or 30 million rand. 20. Well, it'll be met by increased contribution to cover it, through sales, because we're still expecting quite a big increase in sales this year. So we've still got an ambitious plan, but we will man up as the sales come through rather than in advance. And that's always a bit of a catch in our business. Often you man up too late, and then you lose all control in the business. So it's a way. Last year we didn't manage it as well as we could have in both businesses, in FMCG and in the other FMCG business, and in bins and crates. We were perhaps a bit too optimistic about the sales outlook and the promises, because bear in mind, we weren't doing it on a hope. We were doing it on the commitments from customers. But at some point, we should have just said, okay, well, we're not going to carry on manning for this capacity. Yeah.
Hi, Bruce. Hi, Hannes. Sorry for being late again. I know you guys price paper in October. Maybe you can just share what sort of prices you saw, because we've seen in Europe those recycled containerboard prices have kicked up quite materially. Obviously, you guys lag, so that would be interesting. And then the second question is just around the Growers Association expectations. Have those materially changed since the last time we spoke? And then maybe you can also talk about port issues, Cape Town.
What was the second part?
The Growers Association expectations, have those materially?
Okay. So starting with the prices. So our containerboard prices are probably quite stable in the local market. But because the export sales to deep sea markets generally are lower prices than local markets, the average sale price would be down on prior year. So that's the first thing. And prices are under pressure. I mean, we are seeing last year was probably one of the biggest years that we've seen imports come into the country. They're not huge in recycled grades, but they're there. And so that is something that we'll have to manage this year. And I think we've positioned ourselves quite well using our competitiveness from Felixton to position ourselves in the market. But then in addition to that, the cost of waste paper is quite a big variable, because we are seeing the prices, they all over the place actually, but the Indian market is absorbing quite a bit of South African OCC. And if they're prepared to pay, then we would see the prices in the local market tick up following that. I was just reading the RISI reports from the conference in Madrid now, or in I think it's in Madrid, Lisbon, this morning. And it says that sort of OCC prices are under pressure because, of the sanction, the US putting duties on, Turkey banning imports, or basically, in effect, banning imports from Europe because they put duties of $80 on imported waste paper. So there's a lot of international trade dynamics which might affect that. But we've put ourselves in a much stronger position in this part of the cycle now through our interventions over the last 5 or 6 years in our recycling business to weather it. But that would be something we'd have to monitor. I mean, in terms of the CGA's outlook, they moderated it down from the 260 million. They're talking more around maybe 230 or 240 million now. But remember, we did our modeling on about 200 million export cartons, and that still seems quite robust and solid. And we are seeing the growth coming through. I think the marginal producers might lose some of their volume. You know, the people that are not on rivers, that don't have water, there'll be still a lot of disputes, especially in the north, about access to water. And then the last question was about ports. The port issues are still prevalent. They still exist, but they're not as bad as they were a year ago. And, you know, as you probably know, a lot of the industry associations have intervened with the producers to make a plan. So, for example, I think, if I'm not mistaken, 25% of the grapes from the table grapes from the Western Cape went via Namibia. You know, plan in advance, even if the ports were going to be ready, just to manage that. And so there are many interventions like that which have helped quite a bit. And of course, the demand on fruit packaging becomes greater, which is quite good for our business in those circumstances.
Thank you, Bruce. We've got a couple of questions online. We've got the same question from Keith McLaughlin and Matthew Zungel from Utombo Wealth. Your thoughts about the potential ending of AGOA on fruit exporters and thus indirectly on impacting on demand for Mpact products?
So just to clarify that, I think the total amount of citrus that goes to the US is less than 6% of the South African. In fact, it's 6 million cartons of 170, so it's less than 4% of the local market. And it's all from the Western Cape, and it's the best quality fruit. So were it to be excluded from the US for whatever reason, that would be the fruit that goes first to any other market. So they've got quite a good competitive position to ship to other markets, but it would maybe displace some other fruit in other markets. So we're not concerned about that from that point of view, although they would get lower prices for that fruit. But the one thing to bear in mind about the whole US approach to tariffs and what have you is it's about your relative position, not your absolute position. And because the US is imposing tariffs on everybody, just about around the world, you know, you've got to go and look at how you affected in relative terms, not in absolute terms, because I think that's what's going to be the bigger factor, actually, not the absolute tariff or withdrawal of tariffs.
Thank you. We've got
Just to give you an example, Mexico stopped importing waste paper from Europe based on the tariff issue immediately. So there's one that's a swing in a way nobody really anticipated.
Thank you. We've got two questions from Ines Prinsloo from Gemini Advisory. The 2024 dividend of 105 cents is more than 3 times covered by EPS of 327 cents. With 2025 planned capex of only 446 million, can we look forward to an improved dividend for 2025?
Yeah, I think it's clear that our objective is to make sure that shareholders do get cash returns as well as, you know, return on capital, but cash return on capital. And we would look to meeting those cover ratios going forward. So if the earnings are there, we would certainly want to share them with shareholders.
With ROCE for 2024 of only 11.7%, which is before tax, and did management meet any of the STI and LTI ROCE remuneration thresholds?
The answer to the second question is no on the STI. On the LTI, the answer is yes, because it's on an average over 3 years. And the average over 3 years was 16.8%. And that's on a bit divided by capital employed. So it's on a pre-tax basis.
Thank
and
you.
on a short term, it's no. The answer was no.
Rowan Gula from Cronax. How much of Felixton production is exported and what is the outlook for this market?
The maximum we've exported there would be probably about 20%. Do you know the number offhand? Last year? It's about 20%. And the outlook in terms of the export market, we think we can hold our own position there in terms of volumes going through. But importantly, we also believe we can maintain quite a strong position in the local market in terms of its products. Because I was just looking at the cost curves this morning of the European and other producers, and Felixton is certainly a very competitive mill in global cash cost terms. So that's encouraging.
John Aaron from SBG, thanks for the presentation. I see that net debt to equity has declined to 39%. Do you have a target ratio in mind?
Net debt to equity. I'd say, Hannes, do you want to? Hannes is an accountant. He's got a very conservative target.
We generally look at it on we track that as well, but on an EBITDA basis. And I mean, our target is to get it to 1 times EBITDA.
His second question is, what level of depreciation and amortization are you expecting in full year 25? And what ratio depreciation and amortization to CapEx can be expected over the longer term?
So our number for 2025, our budget number is about 750 million, I think, of depreciation. That will depend on when we actually capitalize the project. So that's our best estimate at this stage. In terms of longer term, how we spend in terms of stay in business, I mean, generally that's about 5% of revenue would be your stay in business CapEx for the business going forward. So the number should start to come down in 2026. Yeah, I mean, we've looked at most other paper packaging companies internationally and what their levels are, and it's generally that 5%, maybe 6%, but not more than 6%. Generally 5% is where your stay in business CapEx sits for packaging businesses.
Thank you. There are no further questions.
Well, finally, thank you very much to everybody for attending. We are available for more questions if there are any after the presentation. Thank you and have a good day.
There's a road we keep driving, one where we recover used packaging and recycle it to make new products. It's a journey that drives income opportunities, contributes to the economy, and protects the environment along the way, all before the products are collected to be recycled once more. This is our road to a circular economy. A road paved with endless value. Mpact. Smarter, sustainable solutions.